So for those of you who aren't familiar with the 2-Degree Investing Initiative, we're a not-for-profit think tank with the goal of trying to align financial markets with our climate commitments. And today I'm going to speak directly to the preceding presentation, which recommended scenario analysis be formed by financial institutions. So what I'm going to talk about is a methodology on how to do that. First, the why. I don't think I need to explain to everybody here why we don't want a 6-degree scenario to eventuate. But there's multiple ways that we can get to a 2-degree future. We can have a smooth transition, or we can have a too late, too sudden, a late and abrupt change. This is undesirable for a number of reasons. Financial stability being one of them, but also high transition cost being the other. That it's not the least cost transition. If we do it too late, too sudden, there'll be stranded assets. So what's the overall principle? What do we use to try to do the scenario analysis? So the basis of it is that we take data on physical assets, so power plants, oil fields, and the like, and we try to find out who owns them, and then compare that to these energy transition scenarios. We haven't been working on these methodologies alone. It's been a process that's been happening over the last few years under a number of different projects. We've worked with financial institutions, data providers, other NGOs, and the like. And primarily, the funding for this has come from the European Union. OK, and so to date, we've actually tested this methodology. We've done this scenario analysis for up to 200 financial institutions. For over 200 financial institutions, sorry. So that means that they've given us their portfolio holdings data, and we measured their alignment of their investment with a 2-degree future. We've also worked with 3 financial supervisory authorities who have wanted to test the alignment of various markets under their supervision. In addition, we've worked with finance ministries as well as environmental ministries, and also 2 commercial banks who have invited us in to assess their credit portfolio's alignment with the 2-degree transition. And so all of these are growing rapidly as we have recommendations from the TCFD and the HLEG to the high-level expert group on financial stability on conducting scenario analysis. So now I'm just going to go through a little bit of the methodology to give you a bit of a skeleton of how this process works. So it starts off with what we call asset-level data. This is databases that hold the information about every commercially owned power plant in the world, oil field, car-producing plant, details like the technologies implemented, size, location, and so forth. And so this data is collected from various organizations through company filings, reportings, bilateral engagement with companies, and also through government reports. And the use case for this data is it's actually sold back to the industry as market intelligence. And so what we've done is then, using the funding from the European government, is to go around and buy databases from each of these climate-relevant industries and combine them into one database. So not only do these databases have information about the physical characteristics of these projects, but it also tells us information about who owns these projects and by how much. The next part of the process is then to have a look at these owners and connect these owners to financial service data providers such as Bloomberg, S&P, and Thomson Reuters, for example. And then from this data, we can then start to understand the corporate network of these companies, who owns who, who's a subsidiary of who, and then connect those with the underlying physical projects that are being implemented. Next, by also connecting with these financial service data providers, we can also understand what securities these companies are issuing. And finally, by engaging with investors and asset managers, we can get a transparency on who owns these securities. And so what does this give us? So at this level, this gives us transparency on basically which financial markets own which types of asset classes, which asset classes are related to which companies, where they are, and where their physical assets are. So this is a breakout chart actually from a project we've done with the Swiss Environment Ministry, where we assessed 80% of the pension fund market and insurance fund market through a voluntary program where they sent us their data, and we assessed their alignment of their portfolios with the 2-degree transition. And so what this informs on is can inform on physical risk. So automatically you can overlay this sort of data with water stress maps or storm surge maps to get an understanding of physical risk. But what we want to talk about is actually transition risk today, and how do you actually measure transition risk. And to do that, you need to include these scenarios. And so today we use scenario data from the International Energy Agency, so the IEA, as we heard from today, that map out the technological production pathways for different regions, different technologies to maintain within our carbon budgets. And so the way that we do map these scenarios to the investment portfolios is by a principle that we like to call the fair share principle. And so explicitly, what that is that if you own 10% of the market, then you own 10% of the liability to retire 10% of the fossil fuel assets or any declining technology as prescribed by different 2-degree scenarios, and 10% of the investment required investment required in renewable or green technologies. Okay, so typically what are the outputs of this? Charts similar to this, where we can have a line chart of the investment profile of the current plans of companies, benchmarked against what they should be investing in if they were to be aligned with a 2-degree trajectory. And so we do this for a number of different sectors. They're all listed up here. I'm not going to go through them one by one, and the methodology for each of them is slightly different because the underlying data for each of these sectors is also different, as well as the scenario data. But typically, it covers 80 to 90% of an investment portfolio. So what does this tell us? This tells us, gives us transparency on the existing assets that companies own. It also tells us, gives transparency on the plans of companies, what's in their capital expenditure plans, what are they building in 2 years' time, 5 years' time. But it also gives us transparency on locked-in emissions, the emissions that are basically locked in if the companies don't decide to change their capital expenditure plans or their retirement of fossil fuel-heavy production. In terms of coverage of financial assets, we have this methodology that covers equity, so stocks, so that's the ownership of companies. But we also cover debt and credit as well, so bonds, funds, traded funds, and private equity. And so we don't just look at particular technologies, we can look at sectors as well. So we can, for example, have a look at a portfolio's fuel mix. So if we take an example, if we have an equity portfolio and you own 10% of Toyota, you effectively own 10% of all Toyota's power plants. They have power plants, auto production plants. And so you are responsible for 10% of Toyota's production of electric vehicles, ICE vehicles, and hybrid vehicles. So what we then can tell, we aggregate that over all the companies in your portfolio to come with an ultimate figure of how many electric vehicles you're producing effectively in your equity portfolio. And then we benchmark that with the IEA targets and say, well, how many should you be producing if you were to be in line with the current trajectory of a 2-degree future? And so we can benchmark against the 2-degree pathways, but you can also benchmark against your peers as well. And so finally, just to summarize the use case of this scenario analysis, as I mentioned before, we've done this assessment with over 200 financial institutions. So we've produced a 16 to 20-page report where we've comprehensively covered their alignment of their investment with 2-degree pathways. Secondly, we've just begun a project where we're engaging with companies and giving companies reports on their alignment of their CapEx plans with, so their capital expenditure plans with a 2-degree future. And thirdly, we're working with financial supervisory authorities, as I've mentioned before, who want to monitor the alignment of their, say, their insurance fund sector or their pension fund sector to make sure that they don't have to bail out any of these sectors if they invest away from the government's objective of limiting global warming to 2 degrees. And lastly, we also have a project with the UNFCCC, who will host a platform that will have all these different elements of scenario analysis online. So that includes a web tool where people, investors, and asset managers can upload portfolios and test the alignment of those portfolios with different energy scenarios and get results in real time. It will also list companies and various companies' alignment with different scenarios. And it will also include a financial outlook of the alignment of different financial markets across the world with the energy transition. And lastly, it will include a pledging platform where non-state actors can pledge commitments to the UNFCCC and monitor those commitments over time. So I appreciate that that was broad strokes. There's a lot of methodological details and questions related to that, and happy for anyone to contact me afterwards, and we can discuss them.